Rebecca Walser, president of Walser Wealth Management. I'm joined by Rebecca Walser, president of Walser Wealth Management. Rebecca, it's great to have you with me this morning. Let's start by talking about this $2.3 trillion infrastructure plan and the corporate tax hike that is expected to come along with it, with corporations footing the bill. President Biden wants to increase it to 28%, something he campaigned on. How do you see that impacting corporate America and thus the stock market?
It's a problem, Kristen, and here's why. Prior to the 2017 Tax Cuts and Jobs Act from Trump, we really had a lot of multinational corporations housing, their international profits overseas and not coming ever under subject of the U.S. tax rules. And Ireland, for example, in the Apple case is a really great example of just exactly that. So what President Trump wanted to do was get taxes and corporations to come back, and his act actually was successful. We know that $1.6 trillion was repatriated since the act was passed. What we're seeing now is this administration and Janet Yellen specifically and the president wanting to really go out to the world and sort of sell this, let's not race to the bottom. This is the language they've been using a lot. And what they're trying to say is they know that if they raise the rate from the new 21% revised up to 28%, that MNCs will again look to outside opportunities for tax arbitrage and to get a lower rate. And they're trying to say they're going to go to the Organization for Economic Cooperation and Development, the OECD, and others to really force, and try to get corporations or countries to agree to a global minimum tax rate so that corporations are precluded from really, going and finding and seeking out a tax haven for tax arbitrage. And so this is a very... Yeah,
Rebecca, I mean, there's a lot to break down here, right? And $2 trillion plus, that's a big bill to foot. No doubt about that, especially when you talk about just the range of corporations. We know the big corporations have held up well during this pandemic, but some of these small companies really have taken a hit. It's been extremely hard times. I want to shift gears, though, a little bit, because we got the delayed producer price index this morning, actually rising 4.2% on an annual basis. That is well above the Fed's 2% inflation target. We saw that the 10-year Treasury yield ticked a little bit higher, not astronomical, but at 1.68%, currently 1.66%, I should say. So it's come down a little bit. These rising prices, how much of a concern is that?
It's a concern, Kristen, because we're on, the precipice of a recovery, and we're still not exactly in an organic recovery. As you know, we're still buying $120 billion. The Federal Reserve is still, stimulating $120 billion of purchases a month, which is $1.3 trillion a year. So we are still acting like we're stimulating. We just passed ARP last month for more additional stimulus related to the virus. And so we're just organically starting to reopen and regrow, and we've got a lot of stimulus going on. And that's what's happening is when you're starting to get organic jobs coming back, companies coming back, California starting to reopen, New York starting to reopen, and we're still stimulating $120 billion per month from the Fed. It is giving us inflationary pressure that we are seeing, and it's not the time to do it, not the time to have it when we're trying to really recover from last year.
What does this mean for consumers, Rebecca? We've seen the disconnect between Wall Street and Main Street play out for the past year. I think no one is arguing that by any means. Certainly the jobless numbers that we got yesterday would show that as well. But what does it mean for consumers? They've received, many consumers, multiple stimulus checks at this point, but rising prices is going to create an issue. And I think it could have an impact on consumer spending. That impact to consumer spending is my question.
Absolutely. So in January, with just the $600, stimulus, we saw a 3.4% increase in personal spending in just the month of January. Of course, we saw a dip in February because there was no stimulus. And then in March, $1,400, and that was even more expansive than the original $600 in January. So we definitely see a pickup in personal spending. But like anything, Kristen, when the government stimulus is gone, we'll see a retrenchment, unfortunately. But one thing that the ARP Act did last month is it did give us, in this bill anyways, temporary increased child tax credits that will give about $3,600 for some children and $33,000 for older children for families. So hopefully that will be more of a sustained help until we organically are back to normal. We're looking to that to help as well.
All right, Rebecca, always good to get your take. We got to leave it there. That's Rebecca Walser, president of Walser Wealth Management.